Golden Rule Radio is brought to you by McIlvaney ICA. ICA has been America's foremost precious metals brokerage firm since 1972, helping you build a strategic precious metals portfolio. Call 800-525-9556 to buy gold, silver, platinum, or palladium today, or go to McIlvaney.com. Welcome back to Golden Rule Radio. Appreciate you joining us again this week. We have a special guest, a repeat special guest. Our wise old sage, Rob, is in the studio with us today. And so first and foremost, as we do each week, we're going to do a quick recap of gold, silver, platinum, and palladium and what's transpired in the last week since the last recording.
Thanks, Tori. Yeah, we're looking at gold today on Wednesday, sitting at about $1,789 after coming off that double bottom we talked about last week, here a couple weeks ago, pushing back up, closing in on possibly inching bullish again, but we will discuss the gold chart here in a moment. Silver up to $23.56, still sitting above the magic downside $22 number that I pointed out a couple weeks ago, and a ways to go to get back up into the 30 range. But silver has remained relatively volatile over the last couple months. We'll look at the silver chart as well. Platinum inches back above $1,000 an ounce at $1,002 this afternoon, and palladium continues to show weakness down to about $25.08. $25.08 off an almost $3,000 price here recently. So we do want to take a look at the metals charts, and of course Rob is here for a very special discussion because we are going to, in fashion for us, do a little bit of ratio discussion, but this is going to be a very unique ratio between what the U.S. dollar has done over the last 50 years, availability of U.S. currency compared to the price of gold, and we'll get into that in this show as well. So before I dive into gold, Tori, anything you want to add this week?
Yeah, I mean, it's been flat ever since we rebounded from the flash crash in the Asian market on last Sunday night, 10 days ago. Gold did a great job of clawing its way back. Silver has been stable up off of that 22.25 intraday low that we saw also in the Asian market and the open of the U.S. market. So I'm encouraged by both of those actions. Platinum's got me a little confused right now in terms of it being very, very still. It didn't pull back, but it hasn't taken off either. That's about as flat as it gets. And meanwhile, palladium stays strong. But on the gold front, there are a lot of things that push and pull on the price of gold. Gold will react and respond more than it does from a setting its own market standpoint. And silver will oftentimes react as well economically, less monetarily, and we're going to get into some of that also today. But the gold price gets pushed, get wind in the sails of the price as you see things like high inflation numbers, poor economic data, global uncertainty economically, certainly geopolitical unrest like what we're seeing. And then it gets pulled back down by things like strong bond market and higher yields and better interest rate returns and some of the things that even that we're dealing with in modern society, like decreased COVID numbers or increased economic outlook. And so the perceived risk in the market is very high in some instances and very low in others. So it's not surprising to me that this has been a week of relatively little change in the gold spot price. So that being said, let's dig deep into what's transpired.
Yeah, so looking at the rebound that we had in gold down to last Sunday, the push below 1680 and then jump back up to almost 1800. I know, Rob, you and I talked about this a couple days ago. Do we think gold could keep marching forward over the next few weeks? And I believe I actually said no, if I remember our conversation. I felt like we were coming into a short-term floor. Now, looking back to the July pricing, you had a floor around 1800 and a ceiling at around 1840, and we pushed right into that floor at 1838. And like Tori mentioned, we're seeing a stall. Now, reversals tend to happen pretty quickly, so the longer it sits at around 1790, the more likely it is to jump up to 1840. So personally, I would like to see gold take a little bit of a step down, maybe 1755-ish, and hold there, please, because I am bullish on gold, and I would like gold to take a little step back, half step back, and then jump up to about 1840 and resume the growth that we think we've been seeing in gold since about March of this year. So be on the lookout. If we do get about a $30, $40 drop in gold over the next week, that would be a darn good time to touch base with your advisor here at McIlvaney ICA and pick up a couple ounces. Moving over to the silver price, silver is still sitting at that 382 fib. We still have a rising floor in silver. Silver still remains bullish. Nothing has happened in silver to change my opinion on that. We've got ascending highs, we've got ascending lows, even though we're at the bottom of that channel until we get into lower pricing. Silver anywhere above $23. And frankly, silver anywhere above the lows put in last fall, down around 22 or even a little under 22. Anything above that number is still very bullish in silver. So silver at the bottom of its trading channel is enticing to me from a price perspective to get into. Platinum, we mentioned this last week, came into its first actual retracement since it started going up about 18 months ago. It came to the 50% retracement, has bounced up, sort of like gold, has kind of come into this floor that was put in earlier this year at around 1040, and now platinum is retraced back down a little bit, but we're sitting around $1,000 on platinum today. I'd like to see platinum take another step up, maybe to around 1120. That would make me feel like we're resuming the bull market in platinum. But it was nice to finally see platinum take a little breather. Platinum has been nothing but bullish since March of last year, just like silver, while gold has been trading down since last August when we put in that all-time high just under 2100. Now, all this is on the back of the Dow Industrials, after just almost getting to 36,000, have taken a little bit of a fall. We're back under 34,955 today. And we talked about this last week. I'm going to throw this chart back up, but we won't go into it today. And that's the divergence we've seen between the Dow Industrials and the Dow Transports, which started back in June. Starting in June, the Dow Transports have pushed into a pretty consistent short-term bear market, whereas the Dow Industrials have pushed up higher. And that may lead us into the next piece of our conversation, a question of where is that money coming from? And an even better question, where is all the money sitting these days? So one of the reasons, Rob, we asked you to join us is a conversation you and I have been having over the last week. Just the relationship between stable assets like gold and imaginary assets like, say, in this case, the M2 money supply. I'm looking at the chart and the comparison between those two things over the last 50 years, and are there any patterns we're seeing between not just the value of U.S. currency? You know, I in here talk a lot about the dollar index compared to gold, but that's the dollar compared to a basket of other currencies that are all inflating side by side with each other. Well, what happens when we look at gold just compared to the amount of available cash out there, the M2 money supply?
So what is the M2 money supply? I mean, it's money market accounts, checking accounts, mutual funds, interest-bearing accounts. What am I missing?
Yeah, so the M2 is basically your demand deposits. So that's your M1. That's money that you have access to immediately, supposedly, but supposedly have access to it immediately. The M2 includes additional things, what they call near money. So like you said, yeah, savings deposits, money market accounts, mutual funds, or time-based deposits.
Like CDs.
Correct.
Yeah.
So this is basically the available currency in the market that anybody would have access to in a very short period of time.
And this all started, we had a client that called in saying, you know, gold's never going to go up. They're going to manipulate the price and they're never going to stop. And I just had to laugh when I heard that, because I started buying gold in 1973 when I was a high school sophomore. And at that point, gold had already tripled from $35 an ounce to over $100 an ounce. And I have a lot of clients, when they hear my story, they say, golly, I wish I was buying gold at $100 an ounce. But if you go back to the early 70s, the price of a new car was $2,000, $2,500. A new truck was $3,000, $3,500. Look where we are now. So in relation to the money supply, is gold overvalued or undervalued going back to either just before Nixon took us off the gold standard or just after? And depending upon where you draw that line, we're incredibly, it's hard to say that we're undervalued, but we're certainly not overvalued. We're somewhere in between, whether we start with the gold at $35 an ounce or at $50 an ounce. If we start with gold at about $50 an ounce, like it was in like 72, we're right there. We're at the same price per ounce as if it was 50. Not quite as cheap as it was when it was 35, but I think we've got a lot more to go on now, because people don't think that inflation is transitory.
Well, and it used to be that the inflation was a little bit more of a trickle. It used to be that the money supply was a little bit more steady and predictable, an occasional spike here and there. But it's ramping up, isn't it? I mean, it's like this accelerated parabolic look. That's worth a look at a chart in general, too, the money supply chart. So it's not just that we're continuing a trend since 1970. Gold's gone from 1,050 to 1,785 here since 2016 because of that parabolic rise in the money supply. So the rules of engagement have changed. The MO from a central bank standpoint, not just here, but globally. And we used to think, gosh, okay, the U.S. dollar lost 40% of its purchasing power over the course of that 30 years, and now it's done that in 10.
Right. And it's going to be even more so and shorter in the next few years. So we're going to see increasing cost of goods and services in a shorter time frame.
I like that you bring up the price rise in gold since 2016, because if you look at something like the M2 money supply divided by the price of gold, that's actually the only stagnant period you've had in this chart. So the only time where you've seen gold in the M2 money supply stay relatively at parity, and lo and behold, it goes right back to the 1972 price. That's exactly where that relationship was at that time, has been between 2016 and 2020. So what we're seeing as people are talking about the rampant increase in the price of gold over the last couple of years, going from 1,050 up to almost 2,100 last year, it stayed the exact same compared to money supply. So everything gold has done, you have also lost due to inflation.
Yeah, there's an article in the Wall Street Journal questioning the direct correlation between gold and inflation. And that's an unfair comparison. It's clearly a biased comparison in an attempt to discount the value that it is. But when you take into things like money supply, here you're seeing a very important correlation to it. And we know that they need to flood the market with more money, especially in an economic downturn or depressionary cycle. You're going to see a desperate measure to flood the market, to lower interest rates, to try to drive credit and spending and borrowing and all those things to get the money moving. Because isn't it true, Rob, that despite the money supply, the money's not necessarily moving at the rate that would really warrant true inflation or a non-transitory inflation?
Not at the rate in terms of the total supply of money. It's like a bathtub with a drain, and we've talked about this before, but now we're not just dealing with a bathtub of liquidity called the U.S. dollar M2 money supply. We're talking about the entire bathroom, indeed the entire house flooded with liquidity versus one drain to let it go through. So the money is still moving through the system, but velocity is an indicator of how the turnover of all that money in the system, and there's so much more of all that money than there was just a few years ago. So the drain is the same, the economy is still basically the same, but compared to the total supply of money, it's not keeping up. So it looks like this precipitous collapse of velocity, Wile E. Coyote holding the anvil collapse of velocity, but it's a false indicator, just like inflation is a false indicator. They don't say inflation today is not the same formula as it was 20 years ago, 10 years ago. They keep changing the items that show bad numbers and replacing them with items that show better numbers.
Well, you talked about that when we were off mic and going back to the 30s with the Dow average, and your conversation with a stockbroker. And it's like, well, you can't compare it to the Dow. The Dow performance doesn't even count because there's not an original company in the Dow.
Not anymore.
You talk about, what was our last holdout? GE?
Yeah, it just got delisted a couple years ago.
Yeah, so you just make the numbers look better than they really are.
Well, and they like to start the chart at 1932, and that's what this stockbroker was saying. He's like, hey, from 1932, if you'd have just stayed with the Dow Jones Industrial Average, your $10,000 would be worth $500,000. And I'm like, okay, well, if I buy a bag of uncirculated St. Gaudens in 1932 and pull them out today, that's going to be worth a great deal of money also. Well, you can't do that. Well, you can't do yours.
Yeah.
I'm just stuck here picturing you trying to flush a whole bunch of dollars down a toilet and somebody keeps dumping more into the bathroom. No, it's a really good analogy, and I'm glad you've been chewing on this the last week or two because you see the correlation between gold and money supply. Now, money supply is a little bit more complicated than just how many US dollars are getting printed every month, 85 billion a month plus whatever COVID spending is. Because talking about the velocity question, you have money coming out of other investments that are getting put into these deposit accounts. A deposit account is just an interim holding place for money that isn't working, coming out of the stock market, coming out of real estate, coming out of foreign investing, going into a cash position for a period of time. Velocity is way down, and I would argue there's a dual motive behind that. I do think the average person is moving less money around today than they were 20 years ago, on top of the fact that we have substantially increased the swimming pool full of money that we're trying to shove down a very small drain.
Right.
So I do think it goes both ways there. And then you're seeing this correlation in gold, where gold is, at least as far as M2 money supply goes,
It is
doing
keeping
the exact
pace.
same.
Yeah.
It's almost like owning gold is serving the actual purpose that it's meant to serve.
Well,
Can
Imagine
you
that.
believe that?
you guys, here's the most amazing thing to me is that people are going to count nickels and dimes in the gold price and try to time when to get in. And here you're talking about this increase in money supply. It's $9 trillion we've spent in the last 16 months or so to generate what? To generate $8 trillion in equity market valuation boost and to generate just under $400 billion in GDP boost. It took
Those numbers don't add
$9
up.
trillion.
pushing on a
Yeah,
rope.
that probably doesn't fit your generally accepted accounting principles when your expenditures are still exceeding your
But you're
inflow.
still
Yeah,
pushing on a rope.
Yeah.
Your rate of return is
Oh, let's not forget the interest that's going to be due on that too.
okay, interest alone. But all right, here's my point. We haven't seen real money move into gold yet.
No.
So, Rob, you've got a ton of history dating all the way back here to the early 70s with being a gold buyer. Imagine what happens now that we have, okay, just the equities markets. You've got $8 trillion more dollars in values in the equities markets. What happens when X percent moves into gold this time?
Well, all the gold in the world is only worth $9 trillion. That's it. And we've spent that much in a year, maybe slightly more.
Yes, that's right. And, well, that's created. That's new money. So that's I'm talking proportionally to any other gold rush in U.S. history.
Right.
This one's going to dwarf them all, and there's not going to be enough to go around.
Oh,
Even if you don't
not even
believe in
close.
gold for the purpose that Miles is describing or that we describe on this show, at least buy it now, hold it, and sell it in that market because there will not be supply. There will not be enough product to absorb that many dollars that have been created.
Well, and it's like I tell my clients, gold isn't just for barter or just for an inflation hedge. It is capital, and it exists outside of the system. Its value is separate from the system, and you own it. You hold it. It's not somebody else's debt or obligation. And in 5 years, your capital is secure. You may have made money, you may have lost money, but you still have access to your capital. And that gives you options. Whereas if you stay in the markets or stay in the currencies, you may or may not have access, you may or may not have value, and you may or may not have options. And so all I'm trying to do is preserve my clients' capital to give them options once we get through this period. I hope we can. I hope we don't become like Venezuela, the richest nation in Latin America. Now they can't even keep the lights on. I hope we don't become like South Africa, the richest nation in the continent of Africa. Now they can't even keep the water running. I hope that doesn't happen here in the U.S. Probably won't, but I know that I risk nothing except maybe a few percentage gain or a few percentage loss by parking a percentage of my capital in gold, preserving my wealth, and giving me options in the future.
You know, this real estate market that we're witnessing is a good example of you see rampant buying around the nation. There's real estate turnover has got a velocity that we haven't witnessed. We're witnessing a lot of that. Things haven't slowed down in the gold market.
No.
I mean, we are turning over so many ounces, and yet the paper market is keeping the price suppressed. So Miles makes this manipulation comment early in the show, and that's a blessing. Imagine if real estate was as hot as it is, and yet the prices weren't climbing. You could just keep buying the real estate, and it wasn't impacting the price. But pretty soon you run out of real estate. You know what I'm telling you? Pretty soon you're going to run out of physical ounces. So don't be watching the spot price. Central banks are ramping up their gold buying, and something has shifted.
Yeah.
I'm telling you subjectively, and you guys are on the phone all day too, something subjectively has shifted to where the physical buying is picking up again now significantly, and it's going to go all the way to the level of major hedge funds that, we just saw Palantir buy $50 million in physical.
Right.
That's a drop in the bucket compared to what we're getting ready to see happen.
So that's going to do it this week on Golden Rule Radio. As always, we appreciate you stopping by. If you liked what you heard, do the YouTube things, hit subscribe, ring the bell. If you've got any questions or would like to discuss your personal portfolio, you're always welcome to give one of the advisors at McIlvaney ICA a call. We can be reached at 1-800-525-9556. You can find more info on our website at mcilvaney.com. We're on Twitter at ICA Gold or Facebook at McIlvaney Financial. Thanks for listening and have a great week.